All right, this is the review for um, the first exam in accounting 3302. For those of you who aren't familiar with my review style, um, I send you out old exams. In this case, I'm sending you out 4 old exams, and I am work the problems, and then there's obviously the multiple choice on the old ones, and those I let you look up and find the answers to. Those tend to be a little more conceptual. Um, but I'll work the problems for you, and we'll go from there. So the first one I'm doing is exam 1-9. And so we're starting with number 31 here. At the beginning of 2016, Scarlett Industries began providing 3-year warranty on its products. The warranty program was expected to cost Scarlett 2% of its net sales, approximately equally over the 3-year period. Net sales made under warranty in 2016 were 270 million. 13% of the units sold were returned in 2016 and repaired at a cost of $2 million. This amount was debited to warranty expense as incurred. So we need to prepare the appropriate adjusting warranty expense on December 31st. What is the warranty liability that should be shown on the balance sheet? All right, so the key to this one is understanding that it's the matching principle that is involved here. So even though the warranty expenses, that a lot of the warranty expenses won't come until year 2 and 3, we match it to our sales. And so we're going to record that as an adjusting entry in 2016. So we start off, and we have 270 million, and we expect our warranty expense to be 2% of that, so that'll be 0.02. So 270 million times 2%. So we are expecting a total of 5,400,000. So that's the amount that we will have. Okay. And so I'm going to go ahead and do the warranty expense that's already occurred, the $2 million. You wouldn't have to get this problem correct, but it would just be warranty expense. And I'm just going to go ahead and credit cash. It doesn't tell us whether it's labor or whether it comes from inventory. It says it was repaired or replaced. So if it was replaced, it'd come from inventory. But I'm just going to do cash here for $2 million. If you put labor, if you put inventory, I would go ahead and count that correct on that. But then we have the if we were to do our T account, we have the initial liability of 5,400,000, and then we take the 2 million off. That leaves us with 3,400,000. And so our journal entry on 12/31 of 16 would be warranty expense for 3,400,000, and then we would have warranty liability. And that matches our expense to our sales of the 270 million. So that way we're not having we're not misleading our investors and creditors by telling them that we didn't have this expense that matched the sales. Okay. All right. Number 32. Hot Springs Marine borrowed $30 million cash on December 1st, 2016 to provide working capital for a year-end inventory. Hot Springs Marine issued a 4-month 7% promissory note to Third Bank under a prearranged short-term financing agreement. Interest on the note was payable at maturity. Each firm's fiscal period is the calendar year. Okay, so the first thing that you realize that this is a note for the full amount, 30 million, and not a discount note. There are two reasons that you note that is they borrowed 30 million, right? And that's the first thing. So if they were issuing a discount note, they would issue 30 million minus a percentage, right? So they wouldn't get the full 30 million. So the it's that. And then when it's a discount note, it will always say discount note. All right. So prepare the journal entries for the issuance of the note by Hot Springs, and B, Third Bank's receivable. So number one. So Hot Springs Marine is going to have cash of 30 million, and they're going to have notes payable for 30 million. All right. I'm going to go ahead and slide this over and do the banks over here beside it. And they're going to have note receivable for 30 million and cash for 30 million. So as you can see, it's just the mirror image journal entry there. So this is the Hot Spring, and this is the bank. All right, then number two, it says prepare the journal entries for both firms to record the subsequent events related to the note through March 31st of 2017. Okay, so they did this on December 1st, and since they're they are calendar year, fiscal year, we're going to have to make an adjusting entry on December 31st. So on 12/31, this should have been 12/1. On 12/31, we're going to have 30 million. And remember, interest is always stated on an annual basis. So we multiply that times 0.07. So they would owe 2,100,000 if they borrowed it for the whole year, but they're only borrowing it for 4 months, and we're having to do the adjusting entry at the end of 1 month. So we divide this by 12, and we have interest expense for 175,000, and then interest payable for 175,000. Okay. The bank, on the other hand, would have interest receivable for 175,000, and they would have interest revenue for 175,000. All right. So number 3, suppose Hot Spring issued a $30 million discount note, non-interest bearing note, and 7% is the bank's discount rate. Prepare the journal entries to record the non-interest bearing note. What would be the effective interest rate? Okay, so this was number 2. So number 3, now we've got the discount note, right? And so we take the 30 million, and it doesn't say specifically here, but I'm going to assume that it's that same 4-month period. All right. So we're going to take the 30 million, which we just did, and times 0.07. So 2,100,000, but it's only for a 4-month period. So the easiest way is simply divide by 12, 175, which we knew from before, and then multiply that times 4. So that would be 700,000. So we would take the 30 million minus the 700,000 gives us 29,300,000. So our journal entry for the borrower for Hot Springs would be cash for 29,300,000, and then discount on note payable 700,000, and then note payable 30 million. The bank's entry would be note receivable for 30 million. Their cash would be the 29,300,000, and this would be you could either do discount on note or unearned interest. I'm going to use discount on note. For 700,000, and just to let you know, I don't get too caught up in the exact title names of the accounts, as long as they make sense. If you put down here mother's shoes or something, that wouldn't cut it. But discount note, prepaid interest, or unearned interest, all those, anything that reasonably makes sense, because you're going to find when you get out in the working world, I know a lot of people call it real world, but considering that education is 13% of the GDP of this country, education is pretty real world. But when you get out in the working world, each company is going to have their own accounts and their own account names, and most of the time they make sense. So once in a while, you kind of tilt your head and go, "Huh?" But most of the time it makes sense. And then the last part of this was um, what's the effective interest rate? All right, so we're paying 700,000, and we're getting to use 29,300,000. So if we divide that out, that would be 0.0239. But again, that is only for the 4-month period, right? So there are 3 4-month periods. So we multiply that by 3. Whoops. And we would get 7.17% would be our effective interest rate. All right, number 33. On February 1st of 2016, Fox Corporation issued 9% bonds dated February 1st, 2016 with a face amount of $200,000. The bond sold for $182,841 and mature in 20 years. The effective interest rate for these bonds was 10%, paid annually on July 31st and January 31st. Fox's fiscal year is the calendar year. Fox uses the straight line method for amortization. So prepare the journal entry to record the bond issuance on February 1st. Remember, the straight line method is only allowable if it's not material. And so we're saying that the interest on $200,000 worth of bonds is not material. Okay, so prepare the journal entry to record the bond issuance. So we're going to get cash of 182,841. We're going to have bonds payable, and that's going to be for 200,000. And so the difference is going to be the discount on bonds payable. And so that will be 17159. So 17,159. All right. So number 2. So this was number 1. Number 2 is to prepare the journal entry to record interest on July 31st of 2016. Remember that they pay semi-annually and they're 20 years, so there's 40 interest payments, right? So the first thing we have to do is take the 17,159 and divide that by 40. And that will be our amortization of the bond discount. And that will be $428.97. I'm going to just round that to 429. That'll be that's fine. If you carry out the pennies, that's fine also. But I think rounding's good enough for this. Okay, so our the other thing we have to do is calculate the interest that's going to be paid. So that's 200,000, and the coupon rate is 9%. So they're semi-annual, so 0.045, half of the 9%. So they're going to pay $9,000 in interest every 6 months. So the interest expense is going to be cash is going to be 9,000. We've got to amortize that discount. The discount is a debit, so that means it's going to be a credit, right? So again, it could, your entry here could be amortization of bond discount or just bond discount on bonds payable. $489. And your interest expense will be 9,489. And does that make sense? Yes, because our market rate, the effective rate was 10%, and they're only paying 9%. So our interest expense is greater than the cash paid, right? So we're amortizing that discount on that. Okay, number 3, it asks us to record the journal entry on December 31st of 2016. Okay, so now we're remember with the straight line method, this, if we weren't having to do an adjusting entry, this is the entry for every interest expense. If we did it so it was on June 30th and December 31st, and we had no adjusting entries, this would be the entry for every interest payment. All right. So what we've got to do is we're going to have this is 5/6 of that. So our interest expense is going to be 9,489. 6 divide 5 times, and I get 7,907.50. The discount on bonds payable would be the 489. Divide that by 6 and multiply it by 5 would be 407.50. And so the interest payable would be 7,500. And if you want to work that out, 9,000 divide by 6, multiply by 5, 7,500. So that works out. And then finally, number 4, prepare the necessary journal entry on January 1st of 2017. So a couple of different ways you can get there. We can just look at the difference and get there, because we know this is, this would be the journal entry, or we can calculate it out. I'm just going to do the difference. 9,489 enter, 79,07.5 minus our interest expense. Whoa, something was wrong. 9,489 enter, 79,07.5 minus would be 1,581.50. Our discount on bond payable or amortization of discount would be 489 minus the 407.5 would be 81 and 50 cents. Oops, I left one out. We would also have, I'm going to slide this in here, interest payable, 9,000. Whoops, I'm sorry, interest payable, 7,500. This one. Looked up a line too far. 7,500. And then our cash, would be 9,000. All right. So that's that one. And then finally, calculate the value of some bonds. Miguel Enterprises issues $30 million worth of bonds with a stated interest rate of 8%. What is the amount of cash they will receive in each of the following market rates over the years? So A, it's going to, we do this just like we did in class, 30 million. And for that's the lump sum part. Then 12% would be, and again, it doesn't say specifically, but remember that in America, the standard way of issuing bonds is they have semi-annual interest payments. So we cut that interest rate of 8% in half. So 30 million times 4%. So each interest payment will be 1,200,000 of those. Okay, so now we pull out our present value table. The first one, we need the present value of a lump sum. So that's table 2. And we want 12%, so we're going to cut that in half, 6%. And it's for 20 years, so we double that, 40 periods, 0.09722. And then I'm going to go ahead and flip over and get the factor for the other one. So that's going to be table 4, the present value of an ordinary annuity, again, 6%, 40 periods will be 15.04630. And now we just calculate those out and add them up. So 30 million times 0.09722 would be 2,916,600, 1,200,000 times 15.04630 is 18,055,560. Add those two together. And we get 20,972,160. And then you ask yourself, does this make sense? Yes, it was an 8%. It's gone up to 12%. So the value is considerably, the market value is considerably less than the face value on that. So on B, we do the same thing, 30 million, 1,200,000 We'll save a little time there. Go back to our table. And this time we're 7% for 10 years. So we're going to use 3.5 for 20 periods. So that's 0.50257. And then likewise, we'll go to table 4. And yes, I will provide these on the exam, the exact ones that, so present value of an ordinary annuity, 3.5% is 14.21240. And again, just multiply those out and add them up. And that's worth 15,077,100. And that's worth 17,054,880. Add those together. And we get 32,131,980. And again, you ask yourself, does that make sense? Yes. The interest rate went down, so the value is up. It didn't go down far, and the length of time is not as long. So the up is not near as much as the down on the previous one, right? Now, this last one, C, exact same thing here, 30 million and 1,200,000. And pull out our table. Table 2 is going to be 2% for 5 years, so we're going to use 1% for 10 periods, 0.90529. There, and then flip over to table 4, present value of an ordinary annuity, 1%, 10 periods, 9.47130. All right, and once again, we just simply add those or multiply those out and add those up. That's 27,158,700. And that's 11,365,560. Add those together. And we get 38,524,260. Now the time, it's gone way up. The time element is quite a bit less, but the interest rate drop is a quarter of what we started with. So yes, that makes sense that the market value would be more than the face value of the bonds. All right. I think I'll break this up into each test as a separate video. So I'm going to stop here and then we'll restart the next one.